Welcome back to Talk Tickers. If you're tuned in right now, you know exactly what we're about. We skip the fluff, we ignore the PR spin, and we get straight into the numbers that are actually moving the market.
That's the promise.
Today, we are turning our attention to the unsexy, invisible, yet utterly critical backbone of the modern economy. Amphenol Corporation, ticker APH. They dropped their Q4 2025 earnings yesterday, January 28th. And let me tell you, the vibe check between the company and the market, we're talking completely different planet.
Oh, it was a tale of two realities. It really, really was.
Exactly. I mean, on one side, you've got Amphenol's CEO, Adam Norritt. He kicks off the call from what he describes as a winter wonderland in Wallingford, Connecticut. He was beaming. He called it a perfect quarter, record sales, record earnings. I mean, he sounded like a man who just won the Super Bowl.
And on the other side, you have the traders, you have Wall Street.
Right. You look at the stock chart, and it's a crime scene. The stock closed down over 12%. We're talking a drop from around, 166 down to about 146 in a single session. That is a massive move for a blue chip industrial.
It was brutal. And for people who don't follow this sector daily, you have to understand Amphenol is usually the sleep well at night stock. It's the steady eddy. It doesn't usually move 12% unless, the factory burns down.
So that is our mission for this deep dive. We need to unpack how a company can beat consensus estimates, raise their guidance, book record orders, and still get punished by double digits. Is this a broken thesis? Or is the market just having a massive hangover after a wild party?
I think hangover is the right word. But before we diagnose the headache, we have to look at what they actually drank because the numbers were, objectively huge.
Let's run the highlight reel before we dissect the corpse. Revenue came in at $6.4 billion. That is up 49% year over year.
48%.
They beat consensus by over $200 million. Adjusted EPS was 97 cents, up 76% from last year. Also a beat.
And critically, the guidance for Q1 2026 wasn't soft. Usually when a stock crashes on earnings, it's because the CEO whispered something scary about the future.
Sure.
But Amphenol is projecting revenue between $6.9 and $7 billion for the next quarter. That implies continued growth of over 40%. By almost any standard metric in the industrial world, this is a blowout.
But the metric that really made my eyes pop out, and I want us to spend a minute here because this is rare, was the orders. We talk about leading indicators a lot. They booked a record $8.4 billion in orders in just 3 months.
That is a staggering number.
That gives them a book-to-bill ratio of 1.31 to 1. For the listeners who aren't, glued to their Bloomberg terminals, that means for every dollar of product they shipped out the door, they got $1.31 in new orders coming in the front door.
And context is everything here. In the industrial components world, a book-to-bill of 1.05 is considered healthy. 1.1 is strong expansion. A 1.31, that is a signal flare. That's the market screaming for capacity.
So demand is just off the charts.
It suggests that demand isn't just growing, it is accelerating faster than the supply chain can physically keep up.
So, okay, we have record growth, accelerating demand, and a massive backlog. Why did the market take a baseball bat to the stock price?
It comes down to the setup. You have to remember, coming into this print, Amphenol was up 112% over the last year. The S&P 500 was up about, 16%?
Right.
When a stock runs that hot, it is priced for absolute perfection. The market didn't just want a beat, they wanted a miracle. And while the results were excellent, the mechanics of how they achieved them gave traders an excuse to take profits.
It's a classic sell the news. But let's dig into the what. What is actually driving 49% revenue growth in a massive industrial company? Because the engine here is clearly firing on all cylinders. And the biggest cylinder, obviously, is the one everyone is talking about, AI.
It's the IT datacom segment. This is the part of the business that handles the, let's call it the plumbing of the internet and data centers.
What's the plumbing, yeah.
It now represents 38% of their total sales. And in Q4, this segment grew 110% organically.
110%. For a hardware business, that is software-level growth. And this is where we need to circle back to that $8.4 billion order book.
Yeah.
There was a fascinating moment in the Q&A where an analyst asked about this. They basically asked, is this real? Or are customers just panic ordering to get in line?
The double ordering fear. It happens in every semiconductor cycle. Everyone orders twice as much as they need because they're scared of running out. And then 6 months later, orders just collapse.
Exactly.
Yeah.
But management's answer was, Well, it was revealing. They didn't just say demand is strong. They used a very specific phrase. They said customers are opening their order windows.
That is a term that carries a lot of weight in supply chain management.
Explain that to me. What does opening the order window really mean in this context?
So typically a customer like a Microsoft or a Google might place orders for the next quarter, maybe 6 months out. It's transactional.
Sure.
But when they open the window, they're coming to Amphenol and saying, look, we have a massive multi-year roadmap. We are building gigawatt scale data centers in 2026 and 2027. We need to guarantee you can support us.
So it's not just about buying a connector. It's like reserving factory space.
Exactly. It implies a shift from transactional buying to strategic capacity reservation. It means the hyperscalers are essentially asking Amphenol to be their partner in risk.
It sounded like risk sharing. Norwood basically said these customers are making commitments that give Amphenol the comfort to spend the capital to build the capacity. It's a partnership.
It has to be, because the complexity of this hardware is just skyrocketing. We aren't just plugging in a toaster anymore. We're connecting GPUs like the NVIDIA Blackwell series that are drawing massive amounts of power and moving data at speeds that physics barely allows.
Right.
You can't just ramp that production up overnight. You need assurances.
And speaking of physics, this brings us to the big strategic move they just closed. The acquisition of the CommScope business.
Ah, yes.
They closed this earlier in January, and they are calling it CommScope, an Amphenol company. This seems like the missing piece of the puzzle, doesn't it?
It really does. To understand why, you have to look at Amphenol's history. About 20 years ago, they acquired Teradyne's connection systems that made them the kings of the backplane high-speed copper.
Mm-hmm.
And for a long time, copper was enough. It's cheap, it's reliable. But we're hitting a wall.
The physical limit.
Exactly. As data centers get bigger and speeds get faster, you can't run copper across a football field-sized building. The signal degrades. The resistance creates heat. To move data across a massive AI cluster, you need light. You need fiber optics.
And CommScope brings the light.
CommScope brings deep, deep capabilities in fiber optics and spectral efficiency. So now Adam Norritt can walk into a meeting with a hyperscaler and say, we can handle the copper interconnects inside the rack, from chip to chip where copper is still king, and D, we can handle the fiber optics that connect the racks across the data center.
It's the total package.
It's the total package. It prevents a competitor from getting a foothold. It secures the entire ecosystem. It allows them to say yes to every part of the infrastructure build-out.
It's interesting you mentioned Adam Norritt's approach to this deal because we have to talk about his management philosophy. He spent a good chunk of the call talking about the acquisition strategy. He said something you rarely hear a CEO say. He explicitly said that integration and synergy are words they do not use.
It is the anti-corporate corporate strategy. And frankly, it's the secret sauce of why Amphenol has outperformed for decades.
But explain that.
Yeah.
Because in business school, they teach you that the whole point of M&A is synergy. You buy a company, you fire the HR department, you merge the IT systems, and you save money. Why doesn't Amphenol do that?
Because they know that usually destroys value. They call it the corporate digestion problem.
Corporate digestion.
When most companies buy a competitor, they send in a transition team. They distract the sales force with new email addresses and new bosses. They kill the culture. For 2 years, everyone is focused on integration instead of the customer.
Right. They spend more time in internal meetings than sales meetings.
Exactly. Amphenol flips that. They treat the acquired company like a new family member. They keep the management. They keep the brand. CommScope is going to operate as an independent group within Amphenol.
Wow.
Norritt mentioned going to Shakopee, Minnesota CommScope's fiber hub and just welcoming them. No hatchet men, just welcome to the family. Here's our checkbook. Now go grow.
It sounds empowering. And for a deal this size, we're talking about adding $4 billion in annualized sales. That lack of disruption is probably critical. If they tried to micromanage a $4 billion integration right now, while the AI market is exploding.
They probably drop the ball on the customers.
Exactly. It allows the core business to keep sprinting while the new business just keeps running its own race, just with better financial backing. It's a federation of entrepreneurs, not a monolith.
But look, if this was just an AI story, the stock might have held up better because AI is still the buzzword of the century. But this deep dive isn't just about AI. What struck me in the report was that the growth was surprisingly broad.
Yeah.
It wasn't just data centers carrying the load.
No, and that's what makes the sell-off a bit perplexing fundamentally. If you strip out AI, the rest of the business is still roaring. Commercial air was up 21%. Industrial was up 20%.
And
Defense was up a staggering 44%.
It's up 44%. That is massive. It is, and it speaks to the global geopolitical tension. We're seeing budgets rise everywhere. But there was a very specific nuance in the Q&A regarding this. You know, we're living in a world of tariffs, trade wars, NATO rhetoric. An analyst asked if that threatens their international defense business.
And what did he say?
And Norwitt's answer was, well, it was the definition of strategic ambiguity, but in a good way. He talked about their local strategy.
Local strategy?
Right. This is their defensive moat against politics. He explained that Amphenol doesn't operate as an American company abroad. When they're in France, they are a French company. When they are in the UK, they're a British company.
So
they don't have expats running these factories.
Wait, so no American managers overseeing the plants?
Virtually none. They hire locals, they manufacture locally, and they sell locally.
So if a trade war breaks out between the U.S. and Europe, or tariffs get slapped on imports, Amphenol largely bypasses it.
Theoretically, yes. They aren't exporting widgets from Connecticut to Munich. They're making them in Germany for German customers. It insulates them from the populist rhetoric we're seeing globally. It's a hedge against deglobalization.
Which is incredibly smart. And speaking of Europe, that was another surprise. I mean, everyone is writing obituaries for the European economy right now. Germany's struggling, manufacturing is down.
Right.
But Amphenol saw their strongest organic automotive growth in Europe.
It's a huge counter-narrative signal. While the macro headlines say Europe is in recession, Amphenol's specific exposure is bucking the trend. It's likely driven by EV adoption and the increased electrification of traditional cars. It shows that even in a bad macro environment, the content story, more chips, more sensors per car, is powerful enough to drive growth.
Okay, so let's recap before we get to the pain. We have record growth, massive AI tailwinds, a smart, non-disruptive M&A strategy with CommScope, and a geopolitical hedge via their local manufacturing. I'm sounding like a cheerleader here, so we need to put on our bear hat.
Let's do it.
Why did the market drop this thing 12%? We mentioned price for perfection, but there has to be something in the mechanics. The algorithms don't sell just on vibes.
No, they sell on margins and debt. It's the cost of that growth. You don't buy a company like CommScope for free.
Right.
They took on significant debt to close this deal. And the CFO, Craig Lampo, noted that interest expense is going to be around $200 million per quarter in 2026.
That's $800 million a year just in interest payments. That eats directly into the EPS.
Exactly. It's a headwind. And then there's the margin mixing. This is the part that likely triggered the automated selling. Amphenol is a margin machine. They run adjusted operating margins around 27.5%, which is elite for a hardware company that's near software levels.
And CommScope isn't there.
Not even close. CommScope is running in the high teens. So when you blend those two businesses together, CommScope acts as a drag. It dilutes the overall margin by over 100 basis points initially.
So the algorithm traders see margin compression in the headline and just hit the sell button.
Right. Even though management says they can improve those margins over time, and Amphenol has a track record of doing exactly that. Right now, on paper, the company became slightly less profitable on a percentage basis the moment the deal closed.
I see.
Combine that with the acquisition-related costs, about 10 cents per share in Q1, and you have a messy quarter for the strict accountants.
And messy is the enemy of a stock trading at 30 or 40 times earnings.
Precisely. When you're priced as a luxury good, you cannot have any scratches on the paint. And acquisition costs and interest expenses are scratches, even if the engine under the hood is brand new and powerful.
So we have a valuation reset, a 12% haircut. For the listener trying to make sense of this, does this break the thesis? Or does this just make the stock, reasonable?
Fundamentally, nothing in the earnings call broke the thesis.
Yeah.
In fact, the order book strengthened the thesis.
Right.
The thesis is, the world is becoming more electronic. AI requires massive infrastructure, and Amphenol is the best at connecting it all. That is intact. What broke was the valuation multiple. The market is just deciding that maybe we shouldn't pay quite as much for that growth today as we did yesterday.
It's a reality check. But reality checks can be opportunities if you're looking at the right time horizon.
It's definitely a moment to reassess. If you loved the company at 166, you have to ask yourself why you wouldn't like it at 146, provided you believe the CommScope integration won't be a disaster.
And given their track record of not integrating, that risk seems lower than with other companies.
Well, I would agree.
All right, we've covered the numbers, the strategy, and the bear case. Now it's time for this segment where we throw caution to the wind. Please remember, what you're about to hear is absolutely not financial advice.
Not at all.
We are just two voices in your headphones theorizing about the market. Do not trade on this.
Seriously, don't. We are just brainstorming here.
But if you were a hedge fund analyst pitching a wild idea to your investment committee based on this call, what is the trade?
Okay, hear me out. I call this the chameleon arbitrage trade.
The chameleon arbitrage. I'm listening.
So look at the macro picture for 2026. Everyone is worried about trade wars and geopolitical fragmentation, tariffs, border taxes, made in America, made in Europe. The market is scared of global industrials because supply chains are about to get weaponized.
Right, the deglobalization trade. If you make stuff in China and sell it in the U.S., you are in the blast zone.
Exactly. But we just learned that Amphenol is a chameleon. They have no expats. They're indigenous everywhere. 350 factories in 40 countries. They are immune to the foreigner tax because, effectively, they aren't foreigners anywhere.
Okay, so they are the stealth industrial.
So here's the trade. You go long APH, you buy Amphenol, and you short a basket of centralized, export-heavy industrial peers. You short the XLI index or specific companies that build everything in one hub and ship it to the world.
So you are basically shorting globalization and longing localization.
Exactly. You are betting that the world is going to get messy and protectionist. Amphenol bypasses the tariffs because they're local. The export-heavy competitors get crushed by tariffs and supply chain nightmares.
And the kicker?
The kicker is you get the AI boom for free. You are hedged against World War III or trade war, but if peace breaks out, you still own the company, wiring up the biggest technology shift in history. It's a volatility hedge that pays a growth dividend.
A volatility hedge that pays a dividend and wires up the AI apocalypse. I love it. Again, listeners, that's just a theory. Do not mortgage your house on the chameleon arbitrage.
Please don't.
But it is a fascinating way to think about how unique their structure really is. Most companies talk about being global. Amphenol is actually multi-local.
It's a subtle distinction, but in a trade war, it's the difference between life and death.
So let's wrap this up. We saw a record quarter, $6.4 billion in sales, a massive $8.4 billion order book that just screams demand is accelerating. We saw the AI engine revving at 110% growth, and we saw a market that decided to take 12% off the top because the price of admission had just gotten too high, and the margins got a little messy with M&A.
The question for you, the listener, is simple. Is a 12% drop a warning sign that the hardware trade is exhausted? Or is it a gift? When a company tells you they have $1.31 and orders for every dollar they shipped, usually you listen.
The plumbing in the AI revolution isn't going to build itself, and it looks like Amphenol is going to be the one connecting the pipes, whether Wall Street likes the PE ratio today or not.
Indeed.
Thanks for listening to this deep dive on Talk Tickers. Keep your eyes on those order books, and we'll see you in the markets.